Hey everyone, Disney reported their latest quarterly earnings results and the stock price is down roughly 10% following the release. So I'll cover those results. I'll cover all of the moving parts around Disney's earnings release. There's a lot to consider as Disney moves from streaming to streaming from the legacy business. And that movement, that transition is causing a lot of disruption in terms of accounting. And I'm going to separate that from the actual business, right? Because there's two different things there. I'll explain that to you in this video. You'll get an understanding of that. You'll also realize what's happening on the other side of Disney's business, which is the theme park segment. I'll go over what's happening there so that you get a full picture of Disney's business, and I'll update my recommendation on Disney stock. Coming into the quarter, I had Disney stock rated as one of my top stocks to buy in 2024. So you're going to want to see if I'm changing that because of what I saw in this quarterly update. So let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so first things first, the top line revenue. 22.1 billion in the quarter. That was up from 21.8 billion in the prior year quarter. So revenue growth has slowed for Disney as business is shifting. It's not really increasing at this moment. It's shifting from the linear segment to the streaming segment. That's one part of the business. The other part of the business, the theme park segment, that's growing. That's still growing, surprisingly. I'll talk a little bit more about that later on in the video. Now, excluding certain items, earnings per share for the quarter increased to $1.21, up from 93 cents in the prior year quarter. And these certain items that they're talking about are these cost-cutting or cost shifting moves, accounting moves, to account for the shift from the assets going from the linear segment to the streaming segment. Disney is taking some write-downs, and these are non-cash expenses that help reduce its income, save money on taxes, while it has the opportunity to do so. But in my opinion, I don't feel these assets have been, have been impaired. Right? Just because you're moving these assets where you used to show them from on the cable or satellite delivery system, and now you're delivering that same content to consumers through streaming connection, right? Just moving it from here to here doesn't mean these assets have been impaired, right? But Disney can take that impairment charge because it can argue that they have been impaired, that the profits are being hurt, which they are because it's disruptive, moving from one thing to another. So they can go ahead and capitalize on that accounting charge, save money on taxes, but it's a non-cash expense, and I'll share with you how the business is still generating strong cash. Okay, so as a result of performance in this second quarter, their new full-year adjusted EPS growth target is now 25%. So they're upgrading their earnings per share for the full year. Again, demonstrating the business is doing well. The business is doing well. It's just shifting from one thing to another. One part of its business is shifting from one delivery system to another delivery system, which in the longer term, I think this new delivery system is going to be more profitable for Disney. But in the shorter term, it can go ahead and capitalize on this tax break on the accounting charge to their goodwill. Moving on, the company says they remain on track to generate approximately $14 billion in cash flow from operations and over $8 billion in free cash flow this fiscal year. The business has recovered strongly from the pandemic, and the cash flow from operations and free cash flow is exploding higher. And these are real cash flows, right? These aren't the accounting charges that it's taking on goodwill. The actual cash that the business is making is soaring, right? They used some of that cash to repurchase their shares. They used $1 billion to repurchase their stock. And then going on, they reiterated that the direct-to-consumer streaming business will be profitable in the fourth quarter, and to be a meaningful future growth driver for the company with further improvements in profitability in fiscal year 2025. I think the streaming segment going to turn profitable, like they said, this year. And then from there on out, the profits are only going to expand. And I think they're going to expand rapidly. I highlighted earlier, I think this new delivery system, the streaming, is going to be more profitable for Disney than the cable. And it's for one simple reason: convenience. Previously, you could only watch Disney's content when you were at home in front of your cable connection. Nowadays, you can watch Disney's content anywhere you go. You're going to take your phone, you can have the Disney Plus app, the Hulu app on your phone, and you can watch anywhere. And people are watching anywhere. And that increased consumption is going to lead to increased profitability, right? The more you consume a company's product, the better it is for the company, the more the company can capitalize on that. The more you're watching, the more ads you're watching, and now all of their services have ad-supported versions. More you watch, more advertising. And oh, by the way, this advertising is more valuable for marketers because with the streaming connection, advertising can be more targeted and therefore drive a higher average revenue per user. And so longer term, streaming, I think, is going to be more profitable for Disney than the legacy segment ever was. But this transition I've been talking about, going from the legacy to the streaming, it's going to be messy and it's going to be choppy, right? So that near-term messiness and choppiness I've been explaining is a buying opportunity for investors, and that's why I had rated Disney as a top stock to buy coming into 2024. So in the quarter, Disney added more than 6 million Disney Plus core subscribers, and the average revenue per user increased by 44 cents. They've been raising prices. The ad-supported version is becoming more profitable, and they plan to launch the password crackdown on password sharing like Netflix has. And I suspect they will add millions more because of that crackdown. There's a lot of people sharing their Disney Plus accounts. The experiences business, this is where the theme parks reside. And revenue grew 10% in that quarter still. I'm still surprised that this segment continues to increase despite all of the price increases the park has implemented, despite how expensive it is to take your family to a Disney theme park. It continues to grow and add more and more revenue. People seem to love this experience, and it's not very comparable. You can't really get this kind of experience from other providers. Sure, Universal Studios has something close, but Disney is the best in class, and people tend to spend to provide joy for their families, and this experience is proving to be a durable competitive advantage for Disney for decades. Segment operating income jumped 12% and the margin expanded by 60 basis points versus the prior year. The third quarter is expected to come in roughly the same as the prior year, so the growth is expected to slow down in the third quarter, but they still expect robust operating income growth at experiences for the full year. So they're finally noticing the slowdown at the theme park segment, which is long overdue. I thought they would experience that slowdown a while ago, given how much people have unleashed this pent-up demand for away from home experience. Disney has benefited from that trend. I thought it would slow down sooner. It's going to be comparable to the same time last year. That's understandable. Let's wait and see just how much that slowdown is. This segment has increased prices by so much. They've increased prices by so much that even if, like, when there is a slowdown, Disney can finally say, okay, we can start to offer some promotions and lower prices a little bit, because it's been, not only have they raised ticket prices, but they raised parking prices. They made in-park experiences like you have to now pay, or you don't have to, but if you could pay $25 or $30 per day and it'll help you skip some lines. So the total cost of visiting a Disney theme park has gone up so much. I wouldn't be surprised if when they see it a slowdown, they can kind of pull back and offer some promotion. All right. And lastly, I'll talk about the the cash, right? And cash flow provided by operations for the quarter ended March 30th jumped by 13% to 3.66 billion. Free cash flow jumped by 21% to 2.4 billion year over year. So robust increases in cash flow and free cash flow. Even though the accounting changes might impact the income statement, which will change the earnings per share trajectory, but the cash flow is beaming. If you look at the first 6 months of its fiscal year, cash flow is up by over 100% to 5.851 billion from 2.262 billion. It's absolutely soaring. So the business is doing well. They're changing, shifting. It's disruptive. It's going to be choppy, but demand for its products are absolutely thriving. Disney is now trading at a forward price to earnings of 18.96, following this 10% fall off after the earnings release. So I highlighted that I did have Disney stock rated as one of my top 26 stocks to buy in 2024, or one of my top stocks to buy. I've also rated it as one of my top 10 dividend stocks to buy in 2024. I last updated this on April 30th. I'm now reiterating this recommendation. I'm keeping Disney as a top stock to buy, and I'm reiterating that recommendation today, May 7th. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.